हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 109 107 32 which talks about financial instrument part 10. Today we are going to discuss some concept related to consolidation and some concept related to embedded derivative, which is split accounting in case of closely held transactions, or in case of not closely held transactions, like in case where separation is required, where split accounting is required in case of closely held transaction, and where no separation is required. Some of the exemptions are given where separation is not required in case of closely related transactions. So we will discuss now. In previous discussion we had discussed the embedded derivatives of concept of derivatives, then accounting of derivative, then we had also discussed the embedded derivative along with the examples. Today we are continuing with that only. What embedded derivative? It is a derivative where host contract is there, and also the derivative accounting. Host contract means main contract is there also, and also the derivative contract is there. So it's a mixture of host contract and it's a hybrid instrument. So today we are discussing the example of equity derivative in case of consolidation. What happened in case of consolidation? All the assets and liabilities of parent company and its subsidiaries are merged together. So all the asset, liability, income, expense, and the equity in equity part, minority interest is to be reflected separately, and holding interest is to be reflected separately in the equity as equity instrument. So example of derivative in case of consolidation: suppose parent, that is R Limited, hold a 70% controlling interest in its subsidiary S Limited. The remaining 30% is held by entity K Limited. So in this case, R Limited is a parent company, S Limited is a subsidiary company, and K Limited is the another entity who hold 30% stake in S Limited, and R Limited is holding 70% stake, and K Limited is holding 30% stake in S Limited. So here two organizations are there, like a parent R Limited, and another entity is K Limited, who is holding 70-30 ratios of shareholding in S Limited. Now, on 1st January 2023, R Limited writes an option to K Limited. Writes an option to K Limited, which grant K Limited the right to sell its shares to parent R Limited on 31st 12/2024 for rupees 1000 crores. Parent R Limited gives a payment of rupees 100 crores for the option. The applicable discount rate for the put liability is determined to be 12%. State by which amount the financial instrument will be recognized and under which category. So, solution, how we will do the solution? On 1st January 2023, the present value of estimated exercise price is to be discounted at rupees 1000 crore, is to be discounted over 2 years at 12%, because 12% is the market rate, and after 2 years, because the date of entering a transaction is 1st January 2023. For an option contract which is held on 31st 12, settlement happen on 31st 12 2024. So it is almost 2 years. So in order to recognize the liability which is to be paid after 2 years is to be recognized today at present value. So we have to calculate the present value of the amount, that is 1000 crores at the rate 12% for 2 years. So it becomes 797 crores. 797 crores become the present value which is to be paid after 2 years as rupees 1000 crores. So we have to make a calculation of that, and in order to recognize the obligation to pay cash of R Limited, K Limited will exercise the option. Recognize today a financial liability, because R Limited has to pay cash to K Limited, if K Limited will exercise the option after 2 years, so R Limited will create a financial liability today. So on journal entries in the books of R Limited on 1st January 2023, at the time making a contract, he only received 100 crores. So bank account debit, and he will credit the other equity, and that is premium which is received for entering into an option contract. So he will credit it at to the other equity put option 100 crores, which is to be adjusted when the transaction is settled. On 1st January 2023, he will also enter recognize the financial liability of put option, because he has to pay after 2 years. So he will create a financial liability for that. So what he will debit? He will debit the other equity buyback, because he is buybacking his. In case of consolidation, S Limited shares is also a shares of P Limited. So he is buybacking the shares of its subsidiary organization. So other equity buyback account debit to financial liability of put option by 797. In this case, we are assuming that the financial year is from 1st January to 31st December. So 31st December 2023, he will recognize the financial cost account debit, which is to be transferred to P&L account debit to financial liability of put option. The closing value of the financial liability, that is 797 crores, on which he will recognize the interest calculation, that is at the rate 12%. So it becomes 797 crore into 12%, which becomes 95.66 crores, which is to be recognized as finance cost transferred to P&L account debit to financial liability of put option. In the next year again, on the date of settlement, he firstly recognized the interest part, that is finance cost PL account debit to financial liability of put option. How he will calculate? He will calculate by 797 crores plus 95.66 crores, which becomes, on which 12% is to be charged. So it becomes 107.14 crores. Closing balance as on 31st 12 2023 of the financial liability becomes 797 crores plus 95.66 crores plus 107.14 crores. It becomes 1000 crores. And the closing balance of other equity put option becomes 100 crores as on the date 31st 12 2024, and other equity buyback is 797 crores, which is lying in the balance sheet. Now on the date of settlement, when the option holder, that is the K Limited, will exercise the option, then what entry is to be recognized? Firstly, the liability component of put option, which is to be 1000 crores is to be paid. So it becomes settled. 1000 crores is to be liability component is reversed, and is to be paid to K Limited. So it becomes liability component of put option account debit by 1000 crores to bank account. The shares of how accounting entry is to be made in case of other equity lying in the books, other equity buyback and other equity put option. Other equity buyback, which is to be debited earlier, is to be credited, and other equity put option, that is to be credited earlier, is to be adjusted with that, and remaining amount, the balancing figure, is to be transferred to equity share capital or reserve to other equity buyback 797 crores. So other equity buyback, which is 797 crores, is to be credited. Other equity put option is debited by 100 crores, and balancing figure is to be transferred to equity share capital or reserve by 697 crores. In this way, accounting entry is to be done. Now, there is another concept which is related to import-export transaction. That is, we had already discussed this transaction in case of embedded derivative. We are taking the another example in order to clarify the concept in another way. In case of goods, if you are selling, we have discussed the purchase concept. Now we are discussing embedded derivative in case of sale of goods. So suppose on 1st January 2023, R Limited receive an order, only order from US. from a foreign entity for sale of goods on 30th June 2023. So R Limited receive an order. Only he receives the order, not he had executed that order. He receives the order from a foreign company, which is US based company, for supply of materials, for supply of goods to the foreign company on 30th June 2023. So he entered into a forward contract, 6 months forward contract with a foreign company at the rate rupees 85 per dollar. Spot rate on 1st January 2023 becomes 79 per dollar. Spot rate on 31st March 2023 is rupees 80 per dollar. On 31st March 2023, 3 month forward contract is rupees 87 per dollar. Spot rate on the date of settlement, that is on 30th 6 2023, is 90 per dollar. Sale price of the goods is to be contracted for 9 lakh dollars. So how we will make a entry? Firstly, we will evaluate the derivative, embedded derivative, because in these transactions there is a host contract and there is a derivative contract. Two contracts are there. So since the functional currency of R Limited is in INR, how the contract is denominated in USD, that is the value of contract is dependent on the change in foreign currency. No initial investment is required. Value of foreign currency to be decided in future. So it is fluctuating, it will be decided in future. Thus the change in foreign currency in that is USD is an embedded derivative. How it is embedded needs to be accounted at fair value through profit and loss account. That is, change in fair value is to be recognized in P&L. In case of host contract, here host contract is sale of goods and derivative contract is denominated in USD. The contract which is denominated in USD, that is the change in foreign currency. On 1st January, general accounting entry will be on 1st January 2023. That is on initial recognition. No entry is to be required for derivative because the value of derivative is zero at the time of making a contract. At the initial and also there is no supply of goods, no delivery of goods. So both the host and contract and derivative contract is not to be recognized, because on contract date, that is on the initial date, on the date of making contract, the delivery of goods not takes place. The actual delivery of goods happens on the settlement date, that is on 30th June 2023. So on that date only the accounting entry for the supply of goods is to be happen. Initially, at initial recognition, only the paper entry, only the contract is prepared, which is an executory contract. On 31st of March 2023, there is a change in fair value from 85 to 87. So we will book the gain because the contract is entered for 85, but now the rate of USD becomes 87, so there is a gain of 2 rupees. So that 2 rupees is to be recognized as fair value gain. So derivative asset account debit by to P&L income, that is gain on derivative, 9 lakh dollars into 2, so it becomes 18 lakh dollars. On the date of settlement, that is on 30th June 2023, there is a gain, again gain of gain happened because the dollar rate increased from 87 to 90. So in this case, the contract is entered for 85. The spot rate on the date of settlement becomes 90. So there is a gain of 5 rupees, rupees 5 per dollar. So how many dollars are there? 9 lakh dollars are there. So we will recognize the gain. Derivative asset account debit to P&L income, that is gain on derivative. That is how much gain are there? 9 lakh into 45, 9 lakh into 5, that is 45 lakh. We had already recognized the 18 lakhs. So we will recognize only the balancing amount, that is 45 minus 18, it becomes 27 lakhs. Now on the delivery, actual delivery of goods, when the sales happen, so what we will do, if we will receive the consideration, then we will recognize bank account debit. But if we will not recognize debtor account debit by 7 crore 65 lakhs to derivative asset, that is the reversal entry by 45 lakhs to sales, that is 7 crore 20 lakhs. So in these way accounting entries to be prepared. This is a split accounting we had discussed, where we will separate the derivative accounting and the main accounting. But this separation would not be possible, would not be done if the contracts are closely related, which happens in the following cases. In some cases, split accounting is not possible if they are closely related. Suppose in case like transacting party, invoice is denominated in the currency of one of the transacting party to the contract. Means if the invoice is prepared during the whole year in the same currency from one of the parties, in that case split accounting is not possible. Product wise, suppose contract is denominated in commonly traded currency of that product, like some of the product wise the say contract is prepared, like for crude oil, which is to be denominated only in USD generally, because crude oil is generated from we know that from the Arab countries, so generally it is to be um, evaluated the denominated in traded in USD only, which is the common currency. Contract is denominated in USD only, because the product wise some of the transaction happens on due to product wise, so in that case separation accounting separation would not be done in some of the cases. And if the primary economic environment, due to primary economic environment, if contract is prepared or denominated in the currency which is usually happens in a primary due to primary economic environment, like we take the example of South Africa, Nigeria, Zimbabwe, so they are not using their own currencies, they are using the general currencies like USD. They are making contract in USD only. They are not dealing in their. They are not making a contract in their currencies. So in that case, primary economic environment also plays an important role in order, and for that there is separate accounting. Separation would not be done if the contract are closely related, which happens in following cases. These are the exempting transaction in which the split accounting is not possible. No separation is required. Even one of the case is met if one of the all the transactions are mutually different. So if one of the case is met, then that contract are closely related, hence no separation is required. Any of the condition met, then that is to be treated as the contract are not closely related and no separation is. If you like, please share, subscribe my channel, forward to the people who require. Thanking you for watching my video.